Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
$85.67. That is where CAVA closed today, Thursday, February 26, 2026. We are holding firm at record highs following yesterday's massive gap up to $84.76. But honestly, the price is the boring part. The real story here is the volume. We saw 14.4 million shares trade hands on the breakout day. To put that in perspective, the daily average is what, 3.8 million?
Yeah, right around 3.8.
Right. So that is nearly 4 times the normal activity. You do not get that kind of movement from retail traders just clicking buttons on their phones. That is a tidal wave of capital forcing its way through a very small door. I represent the view that this is structural, a massive decoupling for the brand.
It is certainly a tidal wave, but I represent the view that we need to be very careful about how we characterize that water. What we are witnessing is a violent re-rating driven as much by market mechanics as by any fundamental truth. You have a stock surging 25 to 26% in a single session. The Relative Strength Index, the RSI, has shot above 70 into deeply overbought territory. When you see a move this vertical, accompanied by that kind of volume, you have to look under the hood. To me, this screams panic buying. And I don't mean panic from people missing out. I mean panic from people who are trapped.
I see why you might call it panic, but I call it a wake-up call. The market is signaling a definitive decoupling. Look at the context. The rest of the restaurant industry is stuck in the mud. They are fighting over scraps, running defensive promotions, discounting their menus just to get bodies in the door. CAVA has separated itself from that pack. The price action we're seeing breaking through that psychological $85 barrier is the market acknowledging that CAVA has graduated. It's no longer a speculative small cap. It is becoming a core institutional holding. The flow is effectively being cornered by investors who realize they are underweight on the only real growth story in the sector.
Cornering the float is a very polite, sophisticated way of describing a gamma squeeze. We have to be honest about the setup going into this earnings print. Short interest was sitting at 16.17%. That is a crowded trade. You had over 16 million shares sold short with a days to cover ratio of over 7. That means it would take 7 days of normal volume just for the short sellers to buy back their positions. What happened yesterday wasn't just a vote of confidence. It was a mechanical liquidation. Short sellers got caught offside. They were forced to buy at any price to cover their positions. And that buying pressure forces options market makers to hedge by buying the stock too. It creates a distortion field. You're looking at $85 and seeing value. I'm looking at a valuation that is completely detached from reality because of a technical squeeze.
I think attributing this entire move to short covering sells the fundamental achievement way too short. The smart money has voted, and they voted with their checkbooks long before the squeeze happened. Look at the accumulation from Tier 1 institutions in the filings. AllianceBernstein increased their stake by over 153% in the fourth quarter. They now hold nearly 7.5 million shares. Capital Research Global Investors crossed the 5% ownership threshold, increasing their position by 27%. These aren't day traders looking for a quick gamma pop. These are massive asset managers building permanent capital positions for the next decade.
Right, but
Let me just finish this thought. They see what the Q4 2025 earnings confirmed on February 24th. CAVA has officially broken the $1 billion revenue threshold. They hit $275 million for the quarter, beating consensus estimates. That is the fundamental engine driving the train, not just the short sellers.
I won't dispute the revenue beat. Hitting $1 billion is a milestone, but we need to talk about the quality of that beat. You mentioned the same-store sales, the SRS, coming in at positive 0.5% against a predicted decline of 1.4%. On the surface, sure, that looks like a triumph. But dig into the composition of that number. Guest traffic actually declined by 1.4%. Fewer people walked through the doors in Q4 than they did a year ago. The entire growth metric came from price and product mix, which was up 1.9%. You are paying a massive premium for a company that is technically shrinking its customer base, even if they are extracting a few more dollars from the ones who stay.
That is exactly the point. Pricing power. In an economic fog where peers are seeing traffic collapse unless they give the food away, CAVA maintained positive comps. They are successfully executing the Chipotleization of Mediterranean food. They defied the prediction of 1.4% decline and flipped it positive. That speaks to the resilience of their customer base. These are affluent, health-conscious consumers who aren't trading down to fast food just because inflation ticked up. The market is paying a premium because CAVA is proving it can navigate a choppy macro environment better than anyone else.
Paying a premium is an understatement. At $85 a share, we are looking at a forward PE ratio of approximately 122 times. The industry average is 19.25 times. You are paying 6 times the industry multiple for a company with negative traffic growth. The PEG ratio is nearly 5. Generally, value investors get nervous when a PEG goes over 2. A PEG of 5 implies the market is pricing in absolute perfection for a 1,000-unit expansion plan that hasn't happened yet. This price level assumes that nothing will ever go wrong, that execution will be flawless for the next 10 years. History tells us that in the restaurant business, that is a very dangerous bet to make.
I want to circle back to this idea of decoupling because I think it's the central thesis here that justifies the multiple. You mentioned the valuation gap, but that gap exists because CAVA is fundamentally different from its peers right now. Look at the pricing strategy in 2025. Competitors like Chipotle and Sweet Green were aggressive. They took significant price hikes to protect margins. CAVA took less than half the price hikes of its peers. They kept their powder dry. And despite showing that restraint, they still grew revenue 21.2% year over year.
Which is impressive restraint, I grant you.
It is more than impressive. It's strategic brilliance. They are offering an everyday value proposition where their bowls are priced about 10% below CPI increases. They are positioning themselves as the sane option in an inflationary world. This attracts a specific type of customer, someone who has money but is tired of feeling gouged. That customer is sticky. While Chipotle is reporting choppy spending from their lower-income cohorts, CAVA's management noted that demand was firming in Q4 and strengthening into early 2026. That divergence is why the stock is re-rating.
I agree that the value proposition relative to inflation is a nice narrative, but the data on traffic is a warning flare you cannot ignore. A 1.4% drop in traffic is a crack in the foundation. If you are truly the sane option and the value play, you should be gaining share of stomach, meaning more foot traffic, not less. And let's look at the technicals you mentioned earlier. Yes, the Arun indicator and MACD are bullish right now. Of course they are. The stock just went vertical. But parabolic moves like this, where you gap up and leave a vacuum of trading below, often result in gap fills. The market has a way of returning to the scene of the crime. The stock is priced for perfection, yet we are seeing signs that the consumer is getting tired.
I don't think the consumer is tired of CAVA. I think they are just getting started. Look at the 2026 guidance. Management is projecting same-store sales growth of 3 to 5%. The consensus was sitting at 3.16%. They are guiding above the street, and they are backing that up with aggressive unit growth. 74 to 76 net new units this year. That's 17% unit growth. They're entering new markets like Cincinnati, St. Louis, and Columbus. And here's the kicker. The new units from the 2025 cohort are performing at record levels. Average unit volumes are trending above $3 million, and new unit productivity is exceeding 100%. The machine is working.
The expansion machine is working, yes, but at what cost? You brought up the 2026 catalyst, so let's talk about operational execution. To hit those numbers, they are relying heavily on menu innovation, specifically the launch of the pomegranate glazed salmon. Now, I love salmon as much as the next person, but management explicitly admitted that this will be a 100 basis point headwind to restaurant-level margins due to the cost of goods. They are introducing a high-cost, high-spoilage protein to drive traffic.
It's a strategic investment. It captures the Mediterranean diet narrative perfectly.
It's their first ever seafood offering. It differentiates them even further from the burger and burrito chains. Think about the operational nuance here. Salmon signals dinner more than chicken does. It signals premium. And let's not forget the return of the white sweet potatoes in January. That was driven by social media demand. Customers were begging for it. This shows they are listening. The salmon launch is designed to drive incremental traffic. If they get the traffic, the margin dollars follow.
They called it penny profit neutral. Think about what that phrase actually means. They are doing more work, sourcing a more complex ingredient, training staff on a new protein, and potentially slowing down the line, all to make the exact same amount of actual profit dollars as they would on a cheaper bowl. They are running faster just to stay in the same place financially. It's a risky pivot. And speaking of risks, the report highlights external threats that you seem to be glossing over. Tariff exposure on packaging and ingredients, a 1.5% wage investment made late last year. They are guiding margins slightly lower for 2026, down to the 23.7 to 24.2% range. When you have a PE of 122, margin compression is kryptonite.
I interpret the penny profit neutral comment differently. It means they are prioritizing market share over short-term margin maximization. That is exactly what a growth company should do in this phase. You capture the customer now, you build the habit, and to ensure they can handle the complexity, look at who they hired. Doug Thompson, the new COO. He's coming from Texas Roadhouse. If there's one company that knows how to handle high-volume dinner rushes and operational complexity, it's Texas Roadhouse. His appointment is a scale-up move. He's overseeing the new zone leader structure to tighten up operations. Plus, they are rolling out kitchen display systems and TurboChef ovens company-wide. They are investing in the infrastructure to handle the salmon and whatever comes next.
The insiders are aligned. Are they? CEO Brett Schulman sold about 21,000 shares in January. He sold at $67.41. Now, obviously, he missed the run-up to $85, but the point is, the people who know the business best were selling into the rally, not buying. Over the 90 days preceding earnings, insiders sold nearly 40,000 shares. If the future is so bright and the decoupling is so certain, why are the executives taking chips off the table at $67?
You have to look at the scale of those sales. Schulman's sale represented only 1.6% of his total holdings. He is still massively invested. Executives sell for tax planning, diversification. It's standard corporate behavior. Compare that 1.6% reduction to the buying we saw from Balyasny Asset Management. They increased their position by nearly 2,000%. Prime Capital made CAVA their fourth largest holding, sitting right behind Tesla and NVIDIA. Think about that company. Tesla, NVIDIA, CAVA. That is where the growth investors see this going. They see a total addressable market that supports 1,000 units by 2032. They are not worried about a small insider sale. They are worried about missing the next Chipotle early in its life cycle.
Comparing a hummus bowl company to NVIDIA is exactly the kind of exuberance that makes me incredibly nervous. One is powering the AI revolution, the other sells pita chips. I understand the growth story, but the gamma squeeze distorts the institutional picture. When options market makers are forced to buy, that volume shows up on the tape, but it's not fundamental demand. It's hedging. It's math. Once that energy dissipates, once the short sellers have covered and the call options expire, who is left to buy at $85? The air gets very thin up here.
The air is thin because we are climbing a mountain no one else can climb. The comparison to NVIDIA isn't about the product, it's about the scarcity of growth. In a consumer discretionary sector that is shrinking, CAVA is expanding. Funds must own the stock to keep up with their benchmarks. If you are a growth fund manager and you don't own CAVA, you are underperforming. That creates a structural floor. The technicals back this up. The stock cleared its 50-day and 200-day moving averages in a single session. That triggers algorithmic buying that supports the price. The chart has printed an inverted head and shoulders bottom. The bear market is over.
And that algorithmic buying is just as fickle as it is fast. If Q1 numbers show any weakness, if that traffic number drops from negative 1.4 to negative 2.0, the unwind will be just as violent as the rally. You talk about structural floors, but a floor built on 122 times multiple is made of glass.
But that's the bet, isn't it? I'm betting on the 3 to 5% growth guidance. I'm betting on the new markets in the Midwest.
And I'm looking at the risks.
Tariffs, wage inflation, margin compression. The company is guiding for lower margins in 2026 than they had in 2025. You're paying more for a business that is becoming slightly less profitable per dollar of revenue. That is the mathematical reality.
They are investing in wages and prices to build a moat. That 1.5% wage investment ensures they have the best staff. The everyday value pricing ensures they have the best customers. It's a long-term play. The inverted head and shoulders bottom is in. The bear market that took the stock down 60% from its highs is over. We are in a new cycle.
A new cycle, perhaps. Well, let's be realistic about the easy money. It has been made. Anyone buying today is buying hope. You are buying a 122 PE. You are buying the hope that salmon drives traffic without killing service times. You are buying the hope that tariffs don't spike packaging costs. The risk-reward at $85 is simply not favorable compared to where it was at $65 just a week ago.
And I would argue that at $65, the market didn't understand the story. Now at $85, with the volume and the institutional validation, the story is clear. The breakout is confirmed.
The breakout is confirmed technically, sure, but fundamentally, trees don't grow to the sky, and certainly not in a straight line.
Let's pull all this together because I think we framed the choice for listeners quite clearly. From my perspective, the price action we saw closing at $85.67 confirms a new floor. The technicals, the inverted head and shoulders, the moving average crossovers are textbook bullish. CAVA has proven it is the only credible growth story in consumer discretionary right now. The smart money institutions like Alliance Bernstein and Prime Capital are loading up because they know the path to 1,000 units is real. They are unwilling to be left behind, and others shouldn't be either.
And my perspective is that the easy money is in the rear-view mirror. While the momentum is undeniable, buying a restaurant stock at 122 times earnings requires a suspension of disbelief that I'm just not comfortable with. You have to ignore the negative 1.4% traffic decline. You have to ignore the margin compression guidance. You have to ignore the insider selling. The company is great. I don't dispute that, but the stock is dangerous at these levels. It is wise to wait for the inevitable pullback when this short squeeze energy finally burns itself out.
Well, the market will decide. The Q1 2026 traffic numbers will likely be the ultimate truth teller here.
Agreed. If the salmon strategy works, we'll see it in the foot traffic. If not, that valuation has a long way to fall.
Until then, the debate continues.
Indeed it does.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.